Ever feel like the market is about to leave you holding the bag?
Yeah.
Like 1 minute you're up and the next minute you're down? It's a wild ride, right?
It is. It is.
We're diving into a new system called Higher Margin Requirements, or HMR. And it's all about making those wild swings a little less, terrifying, especially for you, the trader.
Right. Exactly.
Now, this deep dive, we're assuming you've got the trading basics down. You're not a complete newbie to this world.
Yeah.
So we're skipping right to the good stuff, ready to make your trading a little less crash and burn.
Let's do it.
Okay, so the expert we've got here keeps throwing around this phrase, upgraded trading safeguards. Sounds fancy, but what's the real-world impact for, someone putting their hard-earned cash on the line?
Well, this system is interesting because it goes straight for the heart of risk, right? See, by pumping up those margin requirements, the amount of your own money you need to put down for a leveraged position, right before and after some big economic news drops. It kind of encourages traders to maybe think twice before going all in.
So instead of getting swept up in the hype of some crazy interest rate hike, the HMR system is saying, whoa there, buddy, let's not lose our heads.
Precisely. It's like a little voice of reason in the middle of all the chaos. Let's say that non-farm payroll report comes out, misses the mark by a mile. Traditionally, that kind of news would send traders into a frenzy.
Oh, yeah. Been there. Definitely felt that panic.
Right. People making impulsive decisions based on, pure emotion.
So break this HMR thing down for me. How does it actually work in those crucial minutes after, say, a big economic data dump?
Okay, so picture this. The system kicks in 10 minutes before and after, let's be honest. Those really exciting moments.
The moments we all live for, right?
Exactly. We're talking FOMC statements, inflation reports, the kind of stuff that keeps you glued to the screen. During that 20-minute window, if you're opening a new trade, get ready for some temporarily higher margin requirements.
Basically, the system is giving traders a gentle nudge. Like, hey, take a breath, look around. Maybe don't bet the farm when the market's playing hot potato with a hand grenade.
That's a great way to put it. But here's the thing. Any positions you had open before that 20-minute window, totally unaffected.
Okay, so that's a pretty big deal, especially for those of us who are, shall we say, actively trading. It's not like the HMR throws your old game off just because there's a big announcement coming.
You got it. And that's where, that trusty economic calendar becomes your new best friend. Knowing when those waves are coming is everything.
This whole thing really makes you wonder about the future, doesn't it? Are we headed towards a world of automated trading safeguards? And what does that mean for the everyday trader in the long run?
That's the million-dollar question, isn't it? I mean, the system, it's meant to be a safety net, especially during those make-or-break moments in the market.
Right.
But it does get you thinking about the potential downsides, too. What about the traders who, kind of thrive on that volatility? Could it be limiting their potential? And is it possible that this system might create a false sense of security leading to other types of risky behavior? You never know.
Lots to chew on, for sure.
Yeah.
For our listeners out there, the ones already planning their next big move. Keep that economic calendar handy. It might just save you from a market roller coaster you'd rather skip.
Absolutely.
Until next time.